Happy Tuesday out there, Team 42. It's your skipper here, Darius, to present our macro minute for Tuesday, September 23rd, 2025. As always, we'll start with the executive summary from today's lead-up morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is, did Fed Governor Stephen Miran do enough to support our paradigm C bull market? Our answer? Yes, and then some. In our view, Dr. Miran, however politically compromised he may be, did exactly what he was supposed to do in his presentation to the Economic Club of New York yesterday. Specifically, he shifted the narrative surrounding his lonely policy rate projection on the latest dot plot from President Trump to the economic textbooks, and in doing so, he has every Fed staffer and Wall Street economist scrambling to refute his claims. This is exactly where the administration would prefer the narrative surrounding structural regime change at the Fed to reside, i.e., cloaked in economic gobbledygook and stuffed in between the pages of PhD economics textbooks and associated white papers. In short, Dr. Miran's complex model projects the nominal neutral rate in the range of 2.22% to 2.5%. While Dr. Miran believes the Fed balance sheet got too large for political reasons during the COVID-era QE program, so do I, by the way, he sees financial sector deregulation as offsetting the need for the Fed to maintain a large balance sheet to supply adequate reserves to the banking sector. Said differently, a more relaxed regulatory framework would reduce the quantity of capital that banks must hold, particularly against treasuries. Investors should continue to expect substantial financial sector deregulation to be used as a lever to alleviate pressure upon financial markets and credit intermediation in the real economy from fiscal dominance. Dr. Miran's commentary does put to bed the potential for an explicit shift to a 3% inflation target for now. While the Fed may never officially abandon its arbitrary 2% inflation target, those of us who understand the role the monetary authority will be forced to play in this foreturning know that its increasingly loose commitment to 2% inflation as the definition of price stability signals their inflation target is evolving in a manner that is consistent with our 3% equilibrium core PCE forecast and unlikely to alert the frogs being boiled alive in the pot that is the Treasury bond market. Said differently, the most structurally bullish catalyst for stocks, gold, and Bitcoin is a Federal Reserve that undergoes structural regime change deliberately rather than all at once, because the all at once route will cause the frogs in the melting ice cube that is the Treasury bond market to hop out of the pot and destabilize global financial markets. The more this investor cohort remains circumspect regarding the accelerated financial repression and monetary debasement we are likely to experience, the more they will be forced to systematically capitulate into stocks, gold, and Bitcoin at higher and higher prices. Our flagship investment strategy, KISS, featuring risk-managed 60-30-10 stocks, gold, Bitcoin, is well-positioned to continue demonstrably outperforming traditional retirement solutions due to the persistence of such flows over the long term. Moreover, KISS, which we introduced in January 2023, is implicitly backed by the recent asset allocation signaling of legendary investors like Stan Druckenmiller, Ray Dalio, Paul Tudor Jones, and Jeff Gundlach, as well as Morgan Stanley. Trust the process. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's titled Hawkish Reversal in the 10-year Treasury Yield. It says, given that a central bank rate cut is typically a dovish signal intended to lower borrowing costs, what specific macroeconomic signaling mechanisms and market expectations explain the hawkish reversal in the 10-year Treasury yield? Specifically, how did bond investors interpret the Fed Chair's forward guidance on persistent inflation and internal committee divisions to conclude that this risk management cut implies a less aggressive future easing cycle than the policy action itself would suggest? Phenomenal question, fantastic question. So let's just take it right to the chart to deliver the answer here. So this chart is the decomposition of the 10-year nominal Treasury yield indexed to last Tuesday, so the close before last Wednesday's FOMC event. The 10-year nominal Treasury yield has rallied 11 basis points since last Tuesday's close, which factors in, obviously, the movement we saw during Wednesday's FOMC event. And the predominance, more than 90% of the return or of that increase of 11 basis points has come from the 10-year TIPS yield, which is up 10 basis points. Interestingly, the 10-year TIPS break-even rate is up less than 1 basis point. So more than 10 basis points of that 11 basis points has come from the 10-year TIPS yield. We don't have data for the term premium through yesterday and today, but we do have it through Friday. And the term premium was up 8 basis points through Friday when the 10-year TIPS break-even rate was up 2 basis points and the 10-year TIPS yield was up 8 basis points, and the 10-year nominal Treasury yield was up 10 basis points. So we can see that, a decent amount of the immediate response in the financial markets, particularly in the Treasury bond market, came from an expansion of term premia, which is exactly what you would expect if you're talking about a Federal Reserve that is getting less committed to its, getting less committed to a firm commitment to 2% inflation, and ultimately, trying to support the business cycle in increasingly clever ways. And so ultimately what that means is the bond market is having trouble pricing, inflation on a durable basis and pricing growth, because it essentially is, it's kind of shifting the goalposts a bit, if you will, in terms of the signaling. We might have a structurally higher level of inflation, and as a function of that structurally higher level of inflation, we might have a structurally higher level of growth. And those two dynamics are obviously supportive of term premium and higher nominal bond yields. Now, the one thing I'll go back to in terms of the full range of motion we've seen since last Tuesday's close is, the 10-year TIPS break-even rate is up less than 1 basis point. And so anyone who's sort of looking at the reaction, the nominal Treasury yield, and going, oh my God, the bond market's hyper concerned about inflation, is wrong, quite frankly. And the reason they're wrong is because, again, part of the reason in our view that they might be wrong is, one, we are still in the worst part of the U-shaped economy here in the second half of 2025. The worst part of the U-shaped economy gives the Fed a legitimate, credible reason to cut interest rates. And as Dr. Miran outlined in perhaps the most painstaking detail I've ever seen outlined in any speech in my entire career, he outlined very credible reasons using standard academic theory for why the policy rate should be much lower today than it is in the future. And by the way, one of the things I thought was really interesting that was omitted from his signaling was he didn't mention at all any impact of the labor market from AI, which I would argue, I've already heard several very important voices surrounding the institution kind of bring into the discussion. And so if you talk about the potential durable positive shock to unemployment from AI, which obviously the Fed doesn't want to signal because that would freak a lot of people out. But if you're talking about that at all, that suggests that the nominal neutral rate and the real neutral rate are probably lower than they currently are, because you're talking about a bigger output gap. So, this is obviously, as I said yesterday, is a very complicated stuff when you're talking about, the economic frameworks underlying the kind of core monetary policy reaction function that we see here in the United States economy. But the one thing I'll say, going back to the question is, we must remember that the bond market is complicated. You have the real growth expectation, you have the inflation expectation, you have the real term premium, which I would associate more with Treasury supply, and you have the inflation risk premium, which obviously is a function of the Federal Reserve's reaction function to inflation on the long-term time horizon. So the stuff is complicated. The key takeaway, in my opinion, as we said in the executive summary, is if your goal is to run the economy hot without freaking out the bond market, the best possible thing you could do is to gradually turn up the stove top a little bit hotter at a time, so that those frogs that are capitalizing the 30-something trillion dollar Treasury bond market never get too hot, or they never feel the change fervently enough to jump out of the pot. And that's how you can land the plane in terms of both creating a higher level of nominal GDP that would allow the government to outrun the growth of the deficit and the debts in paradigm C, again, without causing adverse consequences in terms of bond yields and ultimately mortgage rates and all that kind of stuff. So it's a tight. I've been saying this for months now. You've been hearing me on this program, on a weekly basis for months. This is a tightrope, a high stakes tightrope. This is literally holding that 20, 30-foot pole, walking on a tightrope, from one tall building to the next. And if they fall off, you could fall off in a way that causes the economy to suffer significantly. You could fall off in a way that causes the bond market to suffer significantly. So this is going to require a lot of thoughtful economic gobbledygook from a lot of credible voices over the next, let's call it 4 to 6 quarters, to complete the transition that we've been calling for the past couple of years. So in terms of structural regime change at the Fed. So we'll wrap it up there. Darius here presenting our macro minute for Tuesday, September 23rd, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.